With the financial market being capricious, the trade spat between the US and China unresolved, and the macroeconomic outlook gloomy, investors need to prepare for volatilities. Investing with a global, multi-asset strategy allows one to include equities, fixed income, real estate, and alternative assets in one basket. Not only does it enhance the stability of the portfolio, but also helps diversify and manage risks. Above all, it provides potential return that is more steady and sustainable. In times of volatility, pessimism sweeps through the financial market. Under that circumstance, a lot of retail investors might make irrational investment decisions, which in turn negatively impacts on their overall return. But investors can always rely on professionals for risk and volatility management amid disorienting market noise. Global multi-asset funds managed by investment professionals comes in handy here. Wary of potential economic downturn, major central banks have become increasingly dovish regarding their monetary policies. The Federal Reserve, in particular, is expected to further cut interest rates in order to deal with potential economic slowdown. Seeking yield and maintaining purchasing power has therefore become the latest mission for investors as the low interest rate environment returns. Those seeking regular potential income could diversify the investment by means of global multi-asset strategy and strive for income by weighing the different distribution policies offered by different share classes based on their financial needs. Apart from the type of distribution share class that you typically see in the market, there are also share classes that entertain flexible payout. The latter not only takes into account expected potential income in the long run, but also net capital gains of all sorts, including those that are yet to be realized. What are the differences between different share classes? Take a chicken farm as an example and assume that the chickens are its capital. Its target is to raise chicks and hopefully sell the grown poultry at higher prices for capital gains. Meanwhile, it also generates dividend in the form of eggs. Just as the market price can go up or down, the number of chickens can vary. Those who invest in the farm can choose between different types of investments. Investor A only cares about capital gains and doesn't need the regular income from eggs. To cater to him, the chicken farmer will help him raise the chicks. And if any hens lay fertilized eggs, the farmer will also raise those chicks from the fertilized eggs. The cycle continues until investor A decides to sell his stakes in the farm. His gains will be calculated based on the market prices at which his chickens are sold. To enjoy monthly income, investor B will sell eggs at market prices from time to time. But since he chooses not to breed more chickens, he will own less chicken than investor A by the time he exits his investments. The initial batch of chicks, which later become grown chickens, is his only source of capital gains. Investor C wants something more than monthly income. He also hopes to reap part of the potential return in advance and therefore chooses flexible payout. Under such policy, the chicken farmer will estimate how much the grown chickens are going to be worth in the future and pay income every month to investor C from selling eggs and chickens that are half grown. Under good chick raising and egg laying conditions, investor C will receive a higher monthly income than investor B. However, as some chickens will be sold before they are fully grown, the capital gains that investor C is going to own eventually will be less than that of investors A and B. It is worth noting that the goal of a chicken farmer is to strive for capital gains through selling grown chickens at better prices. But these chickens under his wings could be compromised or see their value decline due to many factors, including undernourishment and infections. The number of chickens might drop, so are the eggs they can possibly lay. That applies to investment funds too. During market downturn, the distribution or payout percentage of a fund will be adjusted and the potential for its capital gains might be capped. In the worst case, the fund might even run into losses. The goal of the flexible payout share class is to increase investors' potential income through making assessment on future expected return and mobilize the guesstimate for current expenses or investments. Investors should be aware that payout is not guaranteed and may be paid out of capital. Flexible payout as a percentage of the total capital of such funds will potentially be higher than the dividend yields of other distribution share classes, though neither is it guaranteed. Each class, be it flexible payout share class, monthly distribution, or accumulation, has its pros and cons. The most important thing is making the right choice by assessing both your short-term and long-term financial needs.